weekend, all. Ira Epstein with your Metal Market Wrap-Up, and this wrap-up is for Friday, the 27th of May, 2022. Want to wish you all a great and happy Memorial Day weekend. Let's remember what it's all about as well. Sorry about what's going on in Texas. I think all our hearts should be full of sorrow there. Be careful driving, eating, and remember, the markets are open, many of these markets, Sunday night, the electronic session. They close Monday at noon. They'll reopen at 5 p.m. This is all Central Time in many of these markets. So I've sent the hours out as to how it does work, and I realize that's still Memorial Day, but it's what's going to happen. Okay. So we've had a heck of a short covering rally, which is overdue. You had 7 weeks in a row of lower closes in the S&P. The other indexes were falling with it, not hand in hand, every one of them 7 weeks in a row down, but that's where you were, and you finally are getting a bounce. Off the bounce, of course, the pundits are going to say, we have bottomed. That is it. Interest rates have topped out. Inflation's ebbing, and the game is changing. We're going back to the bull market. Well, let me tell you something about stocks. I wrote a piece today in my newsletter that stocks are always in a bull market. Ira, what are you talking? Tell me a 15 or 20 year period where from one point to another, it doesn't end up higher. I mean, that's the nature. Why do you think we're sitting here talking the S&P at 4155, the NASDAQ at 12,000? 10 years ago, what was the number? Forget the recessions, forget all that. 20 years ago, what was it? So what happens in all these markets is companies die, companies get bought out, companies merge, they evolve. New ones come and go. You get people in, people out. But the index goes higher because inflation is making a stock that used to be $5, $20. That's part of what goes on. There's other parts to it, but that's it. Go back, go to 1900, look at the indices, and look where they're at now. So when people argue with me, and the wise guys will come on to the YouTube channel and go, you don't know what you're talking, this is still a bull market. My answer to them, and you all, they're always in a bull market for that reason. It's the time frame you're looking at. So when we look at time frames, I think we're not in a bull market. I think we're in a bear market in a shorter time frame. It's that simple. And that's where I think we're at. I have no concept how long it'll last. I am not saying that I even understood that the last bull market that just ended, and it's over, in terms of shorter time frames, would last 10 years, roughly speaking. Yet flash crashes, okay, you're going to get flash rallies in this market. I have told it to you on a regular basis. But when we get to the metals, they're not paying attention to that. They're looking at inflation, they're looking at interest rates, and economic demand. That's what makes them up. As we take a look at a gold chart, could it be more neutral than where it's at? The answer is no. You are caught in a set of narrow black bands. Those are the Bollinger Bands on a weekly basis. The 18-month moving average is in the red. You are dead center. You've tried to stick your head up off the Ukraine war, invasion, war, whatever Putin's calling it this week, at 2078.80. You backed off from there roughly $200, and the market is sort of sitting right there. The overall pattern is still bullish in that higher lows, higher highs, until on the monthly chart, 1750, 390 is taken out. The next resistance, 1954.80. Momentum is actually pointing down, not up at the moment. When we go to a weekly chart of just closes, the market in the gold market has been in a bear phase, and it's finally getting a bounce. I mean, if you can't see that, don't look at this anymore. When you look at the bar chart, you can see that you've now had a lift. Last week, the market made the lowest low of the break, closed higher, and you're getting a lift from that. Okay, is that bullish? I don't know what it is. Is the market trending? No. I'm not blind that the market's gone from up here, that 2080 level, down to 1785. But in terms of a trend pattern, you have a higher high, lower low. It's a vertical price break when that takes place. It's almost like what the S&P did. It's week after week, lower lows, lower highs until it runs out of that momentum and it gets a bounce. That's the way to look at it. Where's the resistance? Pretty clear. 18-week average. The ideal support, I'll bring you back here, would have been hitting the 100-week average and holding it. Instead, the market slid under it, then it decided to come back to it, then it tried to hold it, and that's where you're at. I mean, it's not difficult to see. The battleground is between these two numbers temporarily. So where's the Bollinger Bands come in? Well, I'll be a son of a gun. Just under where the market was and just under the current top, but it hasn't been hit. So it's there giving a warning, but it hasn't been hit. I'll tell you the numbers that have been hit. Window envelopes. I don't show them here. They're in my morning subscriber videos. Those are the numbers that are working like a dream right now. Markets don't always make a run to the Bollinger Band. They do often, but not always. This market's paying attention to that. So where's momentum? It had been down. So we have a bounce in a market where the momentum's been down. I can't join the bull camp, not on a weekly chart. The gold-silver ratio is still on a weekly basis, not favoring silver. As long as the market is trading with the gold, with these numbers growing, is basically what it is over the 18-week average, it means you need more ounces of silver to get 1 ounce of gold. Let's assume it's a fake world and you go and you steal a grocery cart out of your local grocer. They'll hate me for this. And you put in your ounces. You're 83.92 ounces. You roll down to the end of the mall. Lo and behold, there's a gold-silver guy there. He, of course, is the nicest guy in the world. He charges no commission. He just wants to swap it out for you. You give him 83.92 ounces and you get an ounce of gold. So the higher this goes, the more you have to give him. It's corrected a little bit recently, but it's still over the key average. That's the way to look at it. What we've really done in silver has gone from the upper band to lower band. This one is hitting the numbers. So the gold's missed it, but that's what you've done here. And you're getting a bounce away from that. Now, what silver and copper are counting on is, can China get away from its zero tolerance, or can the COVID drop back enough so that workers can go back? Demand picks up for silver, for copper, and other goods to fill supply chains because people want durable goods and all the other nice things that are made in China. That's what everybody's got their fingers crossed for. If you're reading the stories right now that Apple is having, they're having a nightmare of a story. They just had to cut the amount of phones for their new iPhone that's coming out, their iPhone 14, by 20 million. So instead of 240 million they were hoping for, they're going down to 220. Is that realistic? They don't know themselves. And the reason is, can they get the parts made at the companies? Today, there's a story, I believe it's Bloomberg in the morning, talking about the conditions in some of those factories in China as to, it's like a slave labor camp. You got to read it to understand what's going on. And these people are revolting. They're storming management offices. There's no freedom. They're stuck in these encampments because of COVID. And their life is basically eat, work, eat, work. That's the life that they have right now. Most of them are immigrants, as the story explains. I certainly haven't been there. But I'm getting off track. Not really, though. The key is, this will come alive if China either abandons the policy or COVID there gets under control in some manner, whatever that manner is. And that's what we have to wait and see. Copper's the same. Copper's gone from the upper band to the lower band, and you're getting a bounce. I cannot say this has entered a bull market by any stretch of the imagination. No, nothing. Platinum, same story. It's fighting between the 200-week average and the lower Bollinger Band for its support. Dollar index, now we've got something else. Have you noticed that interest rates have slipped away in the U.S.? Yeah, they dropped down from the 3.15, 3.2 area in the 10-year back to the 2.72, 2.73 range, right? What's going on? Well, what's in part taken place is that now interest rates are going up in other countries, and investors don't have to just turn to the U.S. to invest some money. because they're going to be positive rates in other countries as central banks are fighting inflation. There's one tool to effectively fight inflation in free democracies. That's raising interest rates. Cut demand for the goods, and inflation eventually gets under control. That's the name of the game. So as the dollar's slipping, the euro is getting a lot stronger. I'm sorry, I thought I had another chart on there. But that's the story that is going on. There's nothing bullish here. You've lost your embedded reading. You could be pointing back down now to that, wherever the 18-day average comes in. Now, that 18-day average is moving about 30 points a week if you take a look at what it's been doing, 30 to 50. So this week we should be around 99.40 or so. Price getting, it's not that far away. It could get there. Maybe that's where the market has to go. By the way, that would not break the uptrend. You still have the pattern of higher lows, higher highs on it. It's momentum that is broken down at this point, and until it gets its footing by either correcting more or re-embedding right away, you have to wait and see what you're going to be. One of the biggest responses we're getting are to these pivot points. Traders want to know now more about them. Let me bring you back up to date on just what they are and how important they are. A lot of people like to be in and out during the markets. It makes markets. And one way to do it is using a formula that was not developed by me by any stretch. It was a very famous trader that I know that brought it to its forefront. And this trader used it, and I saw him make absolute fortunes. Saw it with accounts on my books when I had Ira Epstein and Company, the big discount broker. And I watched it. Now, what happened, and I'm party to it, is he got bigger than the market. I mean, people were just flooding money at this gentleman. He had written books on the subject, how to do this, and it was working. I was there. There was another firm, Stotler, at the time. They were one of the firms doing it. And I mean, it was insane. We look at how much was going on. And these were the days of big dollar commissions in the market, no electronics. This was the 80s, so to speak. And it was this formula, and I watched him do it. And I realized that because he'd tell me, and he would tell me, he said, Ira, I'm too big for the market. I cannot take more accounts. In fact, I have to shed accounts. I'm stumbling. When I go to get out, my own orders can't get hit because I've become the market. I believe that is the case. You can argue with me, but that's what I believe. You can't change that. I saw it happening, and I saw that he had to eventually stop what he was doing, in part because he was destroying himself. The system stopped working because he got too big, in part. Okay, and the word is in part. There's always something going on. But I kept it. I watched it. I got trained by him on it. And I saw what went on. And I saw a better way as the electronic markets came on to keep following it. So I put together a 3-part series on it. And you decide, does this work for you? I find that I use it for exit and entry because I'm not a day trader, okay? My technique is that of a swing trader. A trade's good till it gets bad, and because of 90% leverage in futures, trades come quicker rather than later. This is not the stock market in futures. You know that. It's a very different game. Look at today's range, for example, in natural gas. What was it, 60 cents? Come on. But when you look at these, it's all about finding a center line, which the formula does, above the market resistance, below its support. And I decided to use timing factors with it. Now, when this gentleman was doing this trade, we didn't even have the computers to do this. You have it now. You add this to it, and maybe, just maybe, it's something you want to see. It's free. It's a 3-part video course. All you need to do is go to our website to get it. Go to www.iraepstein.com. Under free offers on the top left, it'll be there. You can also take your cursor, move it up to the top here. There'll be an icon. Hit that icon, fill out what you want, and the other goodies that we have. I think you'll find quite a few, and enjoy them. This is the summertime. Look at some of this. Take the time to learn. It's fun to do so, and get yourself ready for what I call the season in September. You have yourself a good weekend, great holiday. I'll see you come Tuesday.